Hello, and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, Commercial Real Estate Economic Update, featuring Ken Rosen of Rosen Consulting Group. This is the fourth session of our virtual 2021 Building Opportunity Conference. More information on our conference and sessions is available in the links provided in your console as well as on mossadams.com. And before I begin, I'm going to play our housekeeping video.
Here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by
All right, and now I would like to turn the floor over to Elaine Irvin, National Practice Leader of the Construction, Real Estate, Hospitality, and Professional Services Group here at Moss Adams. Elaine?
Thank you, Amy. I'm so pleased to introduce our speaker for today. Our speaker is Ken Rosen. He is the chairman of the Rosen Consulting Group, a real estate market research firm. He's also the chairman of the Fisher Center for Real Estate and Urban Economics and professor emeritus at the Haas School of Business at the University of California at Berkeley. He's also a trustee of the Urban Land Institute and a member of the board of directors for several not-for-profit and for-profit entities that deal with real estate, finance, and development. Rosen has authored over 100 articles and 4 books on real estate and real estate finance. And I am pleased to have Ken join us today, and I'm going to turn the floor over to you, Ken, so you can provide us your insight. Ken, it's all yours.
Thank you, Elaine, and thank you, Moss Adams, for sponsoring this. We did one of these about 4 or 5 months ago. Good morning to you on the West Coast, and good afternoon to those on the East Coast. Today we're going to talk about commercial real estate and the economy, and how the recovery is coming, and which sectors are strong and which ones are still coming back, and both nationally and geographically. As we start this morning, we're going to ask you a couple of polling questions. So I'll turn that over to our poll person for the first questions. We're going to have 4 questions throughout it. We'll do a couple at first, and then in between we'll have more questions.
All right, thank you, Ken. So yes, this is our first polling question, and it is, what industry do you represent? A, real estate; B, construction; C, architecture; D, engineering; E, hospitality; or F, other. And we will give you a few moments to respond. To respond, please click the button next to the answer you choose and hit submit. And if you cannot see the submit button, you will just need to enlarge the slide area to see that. And also, just a reminder, if you'd like to receive CPE credit, you will need to respond to at least 3 of the 4 questions that we pull up. All right, it looks like 36% real estate, and then just as many in the other category, and 20% construction. So good mix today. And we are going to jump right into our second polling question to get 2 of these out of the way towards the beginning. So that is, what property type are you most interested in? A, residential; B, commercial office; C, retail; D, hotels and accommodations; or E, net lease or other. And while everyone's responding, I would like to remind you that you can submit questions for Ken using the Q&A window, since we're hoping to have some time towards the end to get to those questions for the audience. All right, it looks like almost half is commercial and office, and then followed by residential. All right, Ken, I will pass it back to you.
All right, thank you. So if we go to the next slide, really I'm going to give you a summary of what we're going to talk about in terms of policy and where we are, and then go into more details. I think the biggest thing to say is that the virus has obviously been the key factor determining the economy and the path of the economy and path of many real estate sectors. But it looks like the Delta surge may have peaked on a nationwide basis, and vaccine optimism may be returning with the widespread use of boosters. I think the most important thing to say is, unlike April and May of 2020, where we shut everything down, we're not going to shut everything down again. We're going to coexist with the virus. I think that's the decisions that have been made, barring another mutation, which leads to a wave that overwhelms the hospital system. I think if we're going to rely on the vaccines and the boosters from the vaccines and masks to have us go on with what we're doing. And that's going to, I think, really be the course of the economy, getting better and better, unless, again, one of these risk factors happen. We've also had this massive government set of programs. We had a $5.3 trillion of new spending, extra spending, under the CARES Act, and last December, $900 billion stimulus plan, and this March, another $1.9 trillion of stimulus. So huge amount of money put in the economy by the federal government in terms of unemployment compensation, PPP loans, rental assistance, a whole range of things that we're trying to cushion the impact. Right now, there's another couple of plans that are under consideration. One is about 500+ billion plan for infrastructure, 500 to 600 billion for infrastructure, hard infrastructure, and then there's another. It was 3.5 trillion. Now they're talking about a $2 trillion plan for social safety net, human infrastructure. They're negotiating in Congress now about both these. We don't know if they're going to happen. But one of the consequences is, if they do, they're talking about pretty big tax increases. And so we're going to have to talk about, what does that mean for real estate and for you as investors especially. There could be some pretty big tax consequences that have been proposed. We don't know if they're going to happen. But the next month or two will tell us that. In addition to the huge spending plan, we've had extreme monetary policy. And probably that's the most important thing to say, that we've had the Fed keep short-term interest rates close to zero now for last 2 years. They claim they're going to do that for another at least another year, maybe 2 years. These rates are really low, lowest in history actually. And we also have this surge in balance sheet. The Fed has expanded their balance sheet from $1 trillion in 2007 to over $8.5 trillion today. So the system is flooded with money, and it's cheap money. So as investors, as players in the real estate market, you've got to take advantage of this. By take advantage, I mean lock it up for as long as you can, matching against the income or owning period of your assets. And if you don't do that, at least hedge the upside on rates, which I think is coming. So these extreme policies are pushing everything. And as a result, we've had a surge of inflation. As we reopen economies around the world, we've had a surge of inflation. Inflation has been running, depending on the measure, over 5% for CPI. PPI is over 8%. The PCE, which is the Fed's measure, is also over 4%. So the target of 2% the Feds and central banks of the world have is well exceeded. We have inflation, we have shortages, we have labor shortages, we have a lot of issues that relate to, I think, an overheated economy. In addition, we have an aging population here in Western Europe and Japan, of course, and China. So that means a lot less workers relative to retirees. And so we're going to see, we've seen acceleration of retirement because of COVID. So all this means this strain is put on the system. Shortage of labor that we're seeing now continues. We've also seen people move, physically move from the high cost, high tax areas like California and New York to lower cost, lower tax venues, different states. And even within California, we've seen people move to places like Sacramento and Fresno. So people are doing this in response to the economic conditions. COVID accelerated this, but it was happening before COVID. I think will continue to happen. We've also seen a sharp slowdown in legal immigration. Legal immigration accounts for 45% of our population growth every year. And partly because of the administrative policies of the last administration, and partly because of COVID, legal immigration has plunged. And so growth, from the point of view of population, has slowed. California has had no population growth for the last year. First time since 1900 that's true. So this is a big deal. We also have a big question mark. As you know, people, as we shut down, many people went to remote work, those who could, white-collar employment in particular. And so at the moment, we have a lot of people working remotely, a lot of events happening remotely, and we are returning to the office very slowly. In New York, it's about 30% of the people back in the office. In Texas and Florida, it's about 50%. San Francisco is 24%. So that has affected basically demand for office space, but also all the businesses around them, retail business around them, restaurants and the like. International travel is very low. We're now about to reopen that again. And convention business is very small. And large venues are starting to open again, concerts, basketball games, football games. But we've had a period where they've been shut. So there's a lot of uncertainty here. Are people going to go back to the office as the primary work location? I think the answer is yes, but I'm going to show you some slides later that indicate employees may not want to do that. We've also seen a continuation of the acceleration of e-commerce. During COVID, we had a 40% jump in e-commerce sales. It was growing about 15% a year before COVID. Now that we've reopened retail, people are going back to stores and restaurants and the like, but still e-commerce is very strong and likely to continue to be moving towards more e-commerce as we go through time. And finally, we've had a surge in single-family housing demand, both for purchase and for rent, as people wanted less dense environments. Extremely low interest rates made it very plausible for many millennials to finally buy a house in a suburban location. And this house price explosion has been everywhere in the country. We've also seen rents in many non-CBD areas surge, and even the CBDs are coming back in occupancy and rent. So housing has been one of the strongest sectors during this environment, and it is really demographically related. The next slide just talks about potential tax changes. And of course, you've got your great firm, Moss Adams, helping you look at these things. We don't know what's going to happen. But part of the reconciliation bill that has been proposed by the Biden administration is sharp tax increases on those who make over $400,000. Doubling of capital gains taxes to 43% from the present number of 20%. Now, the House has written a bill, which may be part of the compromise, to raise rates to 25% from 20%. So that would be a lot better than doubling. There's also the Biden administration has proposed repealing the 1031 exchange, where you can exchange your real estate when you sell it to another property. They've also proposed repealing the step-up on basis, where you you don't pay capital gains taxes, you go to market value at that point for the heirs. Again, these are big changes. If they were to happen, would affect real estate dramatically. Both the House bill's silent on these, and we just don't know. They've also proposed repealing the carried interest availability for managers of real estate, and the House bill proposes allowing it to happen, but only if you hold the new investment for 5 years. There is one offset here. There's a group of congressmen who are trying to get the $10,000 limitation on federal tax deductions for state and local income taxes and property taxes either eliminated or modified, and that would be a positive for those states. Finally, the House has proposed a large surtax, a 3% surcharge on pass-through income for individuals, a 3.8% surcharge on pass-through for individuals, so LLCs, subchapter S's, trusts, and estates, and we'll see if that happens, and a surcharge on those who make income over $5 million. But these tax law changes are being negotiated as part of the reconciliation package, which is basically a big social spending program, so we just don't know what's going to happen, but we know law a lot more in the next 30 or 60 days. So it's very hard to plan, not knowing, but my Moss Adams friends have made me suggesting I do certain things that might mitigate the impact if some of these things do happen. The next slide is where are we in the recovery? So this has been a very unusual recovery. It's a K-shaped recovery. We have a boom going on in the tech industry and software, e-commerce retail, life science real estate, suburban for sale and for rent housing, stock prices, logistics companies, warehouses, an absolute boom. Everything online is booming. At the same time, we've had the slower recovery in convention gateway cities, cities that are dependent on international travel, in restaurants. 26% of all small businesses have closed and not reopened. And we did for a while have weak coastal metropolitan apartment markets. They've now recovered occupancy in places like Manhattan and San Francisco, and rents have actually recovered in New York. They have not yet fully recovered in San Francisco. But where we live and how we work, live, and play has all been affected by the shutdown. And do we return to a normal environment when we're done? Or is there big modifications? So we have to wait and see. But the booms are happening in lots of places. The next slide just shows you this recovery, which is a big red V, versus the previous recoveries from recessions, the last three recessions we had, 1990 recession, the 2001 dot-com burst, and of course the Great Recession of 2008. First thing to say, this COVID-induced recession has been bigger than any one we've had since the 1930s. We shut everything down, so it's a big V. And now we've recovered, I would say 80% of the way in terms of jobs. And again, because of the K, certain geographies and industries are more than recovered. They're booming. There's shortages everywhere. But again, the restaurant businesses in many parts of the country have not recovered. The tourist businesses, the hotel, have not fully recovered. So this could be, as the next slide showed, I call this a pencil recession. We have had a sharp drop. You can see that red line, then a recovery, and then when the surge of the virus happened last winter, a little bit of a shutdown again, the red line there, which is very different than the previous recessions, which lasted for 6 to 10 months of job losses, and they accumulated. This is not that. It's very different. And as you can see from the box, we've gained back 17 million jobs. We lost 22 million. We're getting close. And if the virus continues to decline, I think by the middle of next year, we'll be back at those pre-COVID levels for the overall economy. The next slide just shows you job openings. And we have record numbers of job openings. It dropped a little bit last month, but still 10.2 million open jobs, unfilled jobs. There are more unfilled jobs than unemployed people. And so this question is, why aren't people going back to work? Well, low-end service jobs are facing the biggest shortage, whether it be retail, restaurants. People don't want to go back on those jobs on the same terms and conditions they had before. They're either afraid of the virus or they have gotten so much money from the stimulus checks, from the unemployment compensation, that they've actually got cushions and they are not taking up the job offers. And the immigrant population has been not replenished, and many of those jobs are legal immigrants, or I hate to say it, also illegal immigrants or undocumented workers. So we have a shortage of labor. Also, 1.5 million people retired early and left the labor force, and they're not coming back. Part of it is the surge in stock prices made them easier to retire, and the surge in house prices as well. So I think you're seeing, again, a reluctant labor force. Some have called it the Great Resignation, but we have a shortage of labor today. We've also, as the next slide shows you, we've had a surge in outmigration during COVID from California, New York, and other high-cost, high-tax, high-density states. And you can see the numbers. That's a lot of people leaving. These are people who are there already. Now, normally, international immigration would refill these states and refill these cities. Because of the last administration's policy and COVID, that has not happened. So California had the slowest population growth since 1990. Where are people going? The next slide, the in-migration slide, shows you where people are going. They're going to Florida from the East Coast. They're going to Texas, the Arizona, the Carolinas, Tennessee, and Washington, which have no state income tax. So we're seeing people move for housing cost reasons, for tax reasons, for quality of life reasons. And this is happened before COVID. The next slide just shows you what was happening before COVID. This is California outmigration in 2019. So it's not COVID alone that's done this. COVID accelerated it. But they went to neighboring states, and the neighboring states of Texas. Now you say, is that really neighboring to California? Not quite. But it is a no-income tax state, tremendous job growth, pro-business environment, and no state income tax. But the neighboring states of Arizona, Nevada, Oregon, Washington, Colorado, Idaho, Utah, you're in many of these places, and you know Californians are going there. Quality of life and cost of housing are the biggest ones, but taxes are another component. So what does all this mean for the economy? Well, the next slide shows you our economic outlook for the remainder of this year and 2022. And so that's only 15 more months. That's not giving you total comfort, but we think the recovery continues. The economy, as it gets back towards full employment, grows more slowly. The bottom part of that chart you can see gives you the quarterly numbers, and you can see that we have the growth rate slowing to 3% next year, a little bit lower that at the end of the year. We have the unemployment rate, which is now 4.8%, getting to a level that is hard to believe, but 4.3%, 4.2%, 4.1%, that's full employment. And so the Federal Reserve is looking at this. Inflation is way above their target. Unemployment is close to their target. And labor force participation rates may not get there, but the labor market is in a shortage situation. So we think interest rates move up. The short rate, which is now close to zero, we think they move it up to 0.5% next year, by the end of next year, and 1.5% by basically the end of 2022. We do think that the 10-year bond is already moving up. It's 1.8% already. I'm sorry, it's 1.65% today. It's I think moves up to 1.8% by the end of this year, and moves up to 2.5 to 3 by the end of next year. And that's partly because of inflation. So we got a couple of polling questions for you next about the economy. So I'll turn it back over for the poller.
All right, thank you, Ken. So our third polling question is, what economic factors have most impacted your business in the last year? And your options are A, inflation, B, migration trends, C, cost and access to capital, or D, labor issues or supply chain issues. And while you're responding, I just want to let you know that if you'd like a copy of today's slides, you can download them from the slide deck and handouts window in your console. And we'll also be sending them via email tomorrow along with a recording of today's webcast. We'll leave this up for another 5 seconds. All right, Ken, it looks like over 65% says labor issues and supply chain issues.
Oh, that is really interesting, because that's exactly what we're hearing from all of our clients. The Federal Reserve Board is not hearing that, but they should. So the next slide really talks about what are the risks out there, because we talked about the recovery continuing, but there are real risks out there for really 2022, not 2021. We're almost over with the year, but the biggest risk, I think, really is the virus. I'd like to say it's over and we're going to reopen everything, but new mutations might occur that evade the vaccine. I'm a vaccine optimist. I'm a booster optimist, but that is still a risk out there. No one anticipated this lasting so long and being so deep and pervasive worldwide. We talk about 700,000 people dying in the U.S. of COVID and 3 million people in the world, but if you look at some of the real data, the rest of the world is reporting, especially in developing countries, is bad. Maybe 40 or 50 million people died of COVID. So this is not like the flu of 1918-19, which was much worse, but this is pretty bad. So that's the biggest risk. The other risk I see is policy, that we've gone to such extreme and monetary policy that as we unwind this, it could be very messy. I don't think people are ready or even know that these interest rates are going to go back to normal. Normal would still be 2.5% short rates and 3% or 3.5% 10-year bond. Those are the low numbers. But people, I think, aren't ready for that. And if we do get these big tax increases, I think that many people who are on the entrepreneurial side of the business are going to be very impacted quite negatively and might react negatively. And it's redistribution of income. That is the goal of these tax increases. And I'm not a proponent of that. I think that the system we have now has worked pretty well, but there are inequalities. We know all that. But the tax system is really not the cause of it. The top 25% pay 80% of all the taxes already. To make them pay 95% just seems, howling on. But that is at least what people are thinking about. Also, the surge of inflation. I think there's some transitory nature of it, but I think it's going to be here for a longer time. That look at 3 to 5% inflation, much more likely than 2%. The shortages, I don't think, disappear as quickly as everyone thinks. I think it's going to take a long time, and the labor situation is going to remain tight until we loosen up the legal immigration policies. And I'm afraid that wages again, are going to squeeze profit margins for many companies. Part of what we have happening is, of course, this deglobalization. That China used to be a source of deflation. It's now a source of inflation. Prices for the goods we import from China are up 5 to 15%. A lot of raw materials are up. Energy costs are up dramatically. We are in an economic cold war with China, even though we're importing more than we ever have. We have tariffs in place, and I'm worried about the tensions rising with China. China is the second largest economy in the world. And if we look at that slide, next slide about China, their leadership is doing things that seem to be counterproductive. They're cracking down on their businesses in the tech sector and finance sector and real estate sector. Private education they're cracking down on. The Chairman Xi wants to have common prosperity. And he's, I think, eroding business confidence in a number of sectors. Real estate and infrastructure are very important to the economy, much more important there than here. They account for 30% of GDP. And the crackdown he's doing has eroded things. And if we see a real estate-led recession there, that's going to affect the whole world. Nowhere near what happened in 2008 and 2009, but isn't going to be good. A lot of financial turmoil could happen. Now, China's been good at controlling this stuff in the past, actually better than we have, but that might involve them liquidating some of our treasury bonds, because they owned over $1 trillion of our treasury bonds. And he might try to create a distraction from the economic turmoil by doing something in Taiwan. There seems to be noises being made there. So I am quite worried. There's a book that you might want to read called 2034, a bestseller on Amazon, about the coming potential hot conflict with China. And you might have seen the announcement 2 days ago. They announced a supersonic missile that can avoid our defense system. So I worry about this. I mean, we always look at risks. Economists look at downsides. But I think, we have to look at this as a serious issue. And, of course, you're going to hear a lot more about it. So the next slide just talks about interest rates. And interest rates to every one of you are very important. For those of you who are savers, these interest rates are too low. A short-term Treasury bill, basically close to zero. Treasury bond is up to 165, but still way low. If you look at the long trend, we've gone from rates where it used to be 8%, the risk-free return, then it got to 5, then it got to 3, and now it's 0 for short rates. So those of you who don't like to take risk, there's not much you can do about getting a return unless you do take risk. I think going forward, the issue is what is going to happen. So the next slide talks about what the Federal Reserve Board is thinking. And they, each quarter, ask their Federal Reserve Board members and head of each regional Fed, so about 19 people, to give their forecast of where rates will be at year end. And you can see that in 2021, they say we're not raising rates. They're going to stay at these basically 0.5%, 0.25% level. But as we move through time, more and more participants, each dot is a participant, think rates are going to start normalizing. They look at a rate increase next year, it looks like 1 or 2. And then as we get to 2023, it looks like another 2 or maybe 3. And then as we get to longer run, which is 2024 and 25, I think they're thinking rates on the short end go to 2.5%. Quite frankly, rates should today be at 2.5% with the inflation rate we've got. Rates are suppressed artificially. They're looking at this happening over the next 2 years, 3 years. It might happen more quickly than you think. But that's what they're telling us. Also, as I mentioned earlier, the next slide on the Fed balance sheet, they flooded the system with money. And you can see the Fed's balance sheet was $1 trillion. Now it's $8.5 trillion. So the system is awash with money. All your lenders want to give you money. They charge you for it, but they certainly want to give you more money than they have in the past. Money is loose. The spreads are tight. So there's a lot of money out there. It's pushing up asset values for real estate, for housing, for stocks, for Bitcoin, for SPACs, for a lot of things that don't make sense. The Bitcoin market is worth $2 trillion. The cryptocurrency market is worth over $2 trillion. But there's no value there whatsoever. And there's no control. So I am very worried that we have bubbles out there. And when we unwind this stuff, the bubbles will unwind, and it could affect our psychology more quickly than we think. And what would be the trigger of this? The next slide is inflation. I've mentioned inflation is nowhere near the 2% level we've talked about. We think that this year, we already are inflation rates. You can see 5% on the CPI, in that box, 4.3 on the PCE, which is the Fed's measure they like, personal consumption expenditure deflation measure, and PPI at 8%. So inflation's already out of that range. I don't think we're going to see double-digit inflation overall, but we have seen it in certain components of the index. But we are going to see 3 to 5% inflation going forward, not this extraordinarily low level that we've seen in the past. The next slide just shows you in the housing and commercial real estate industry, we've already seen big construction cost increase. Year over year, it's up 12%. Shortage of labor is the main reason, but a lot of materials have soared. Lumber really soared. It's come back some, but it's still double normal. And everything is going up in a way that is high. Energy cost, oil is over $80 a barrel. So the idea that the Fed can say that we don't have real inflation is transitory, or that the president says it's transitory, they're wrong. It's here. It's now. And the house price increases in particular, and the increases in rent, all take several years to go through the indices they look at. So there's an inflation upward bias, even if other things return to normal, which I'm afraid they're not going to. So we'll now go to our final polling question, and ask you about things you think about.
All right, so the last polling question is, how many days per week are employees physically present at your place of business? A, 100%, B, 3 to 4 days, C, 1 to 2 days, D, 0 days temporarily, or E, 0 days permanently. And we will leave this up here so everyone can get their CPE. And once you have completed all your CPE requirements, you can just download a PDF of your certificate from the CPE progress window in your console. All right, let's take a look at the results. It looks like 30% is 100% present in the place of business, followed by 3 to 4 days and 1 to 2 days.
Okay, well, that's the next question we're going to address. The next slide is, what do employers want and what do employees want? So the next slide just shows you there's a discrepancy. Employers, which are the blue line, want people in at least 3 days a week. 70% of employers want that. Almost 30% of employees don't want to come back to the office at all. So this is a disconnect. I think it's better together, that you want people in the office because you can have the casual interactions, the coordination, the collaboration, the career guidance and mentoring and control. So I think this is a big issue. It's funny that we ask this question now, but remote work has become basically something that a lot of people have liked. The next slide just shows you what share of workers are back in the office. And again, many of you are not in office businesses, but in office businesses, we have about a third of the people back in their office. In cities like San Francisco, it's 24%. New York, it's about 30%. But in Texas, Florida, it's closer to 50%. And clearly, a number of you are in businesses that are customer-facing. People have no choice but to be in their position. But offices, you can do some of that work remotely. So this is a big question we all have. When are people going to get back into their offices? And I think it's a better together. We're doing that paper on that right now. But it's a big question because there is a pretty high availability rate of empty office space that's for lease. In cities like New York and San Francisco, it's 18%. Nationwide, it's about 15%. So this is very unusual. Also, one more slide I'd like to have before we take questions is the for sale housing sector. It has been red hot, and this slide shows you that we've had almost 30% increase in house prices on average around the country in the last 2 years. This is the biggest increase we've ever had, and it is reflective of the very low mortgage rates, which allowed a lot of millennials to purchase. Also, the desire for less density, which a lot of people felt they wanted with COVID, more space because they're working from home. Their gym might have been home. They had to take care of their children at home. We think that's going to moderate, that we're going to see a lot of new supply come online, both home building supply, but also supply come online from people now willing to sell and move. They weren't really willing to show their house during COVID. So the inventories are still pretty tight, but they're moving up. So we think that this is going to slow down dramatically. And affordability is going to be reduced as mortgage rates go up, maybe 100 basis points. So affordability is going to be reduced because the prices are so high and mortgage rates going up. So we think this is going to cool off, but still be a very, very good market, as many millennials have not yet done what their parents did. As you know, that roughly 65% of all people are homeowners, but millennials, the numbers are obviously much lower as they transform themselves into having kids and families. They've been slow to do all that, but we do think that that will happen over the next decade. So at this point, I think we're going to turn to leave about 15 minutes or 20 minutes for questions from the very large audience we have. I should say that I noticed a list of people. Some of you are clients, and as you know, we have actually 120 slides and an hour and a half presentation. This was meant to highlight the points that we have, and we have a full presentation on each metropolitan area because we didn't show you it, but every market's different. You've got a boom going on in places like Austin, Texas, and Boise, Idaho, but we have a lagging recovery in places like San Francisco and Manhattan in certain sectors. So we have it by sector and by geography. Those are the things one have to look at. It's really, as an investor or a developer or a financer, it's a geographic and property type specific world we're in. It's not all boats going up. So at this point, I think I will stop and we'll start taking some questions. And I think Elaine is going to moderate the question and answer part of this program.
Absolutely. Thank you, Ken. I'm going to start with this one. We do have some come in, and I encourage others to make sure that you send in your questions. So the first one is, if the 30-year mortgage rate hits the 4 to 5% range, do you see that will sales activity slow, or is buyer demand strong enough to withstand the higher rates?
I think we'll see a substantial drop in buyer demand because the higher rate compounded with the 20 or 30% price increase will reduce affordability. It already is beginning to, just the price increase alone. So I think we'll see less sales activity. It'll become a more balanced market. Right now it's a seller's market. I think it's going to shift to more of a more balanced market. But again, 4% mortgage rate or even 5% mortgage rate is real low compared to history. People will shift. They'll shift to adjustable rate mortgages where the rates are lower, shorter term mortgages where you might save a percentage point going to a floating 2 percentage points going to a floating rate mortgage, maybe a percentage point you'll save going to a 7-year or 5-year mortgage. So there'll be some offset, but I do think sales will slow. It's probably as much as 15 or 20% if this happens. So if you're planning to sell, probably good to do it sooner rather than later. Of course, price increases are so big that you may not want to believe me and think that prices will continue to grow at 20% a year. I don't think that's the case. I think sharp slowdown in price increases all coming over the next couple of years.
All right, thank you. Oops, let me scroll down. So let's talk about real estate cap rates. What would the longer term impact on real estate cap rates, what would it be with elevated inflation?
Yeah. So let's start by saying that real estate cap rates today are bifurcated. In industrial and apartments, in the best properties in the best markets, cap rates are 3.5%, lowest in all of history. If you have a retail shopping center, a B or C shopping center, the cap rate may be 8%. So they're very, very disparate. Cap rates on a whole have come down a lot for the best quality properties in the best locations, but even in secondary and tertiary markets, cap rates have come down a lot. And it's because the cost of debt's so low. A typical real estate transaction might have 50 or 60% debt, but apartments might have 80% debt. So as debt rates move up, cap rates could move up. But remember, cap rates are still high relative to a treasury bond of 1.6%. Treasury bonds, which were a percent lower a year ago, are still near record lows. So that's why cap rates are so low. I think as we see more inflation, if your property is going to see rent increases, you're going to still want to buy that property because the rent increases can offset any cap rate increase you have if you have 5 to 7 or 10% rent increases. On the other hand, if rent increases can't be passed through, if you can't pass through some of the cost increases you have, or you've got a high vacancy rate in certain property types and markets, if you can't pass rent increases, then that makes you less desirable to buy some of those properties. So inflation generally has been good for real estate. Replacement cost, as you saw, was up 12%. That's been good for real estate. I think inflation in the 3 to 5% range is not a problem. But when we get big inflation, of course, that becomes a different issue.
All right, thank you. You had touched upon China. So from your perspective, could China's real estate debt issues have repercussions for the U.S. real estate markets?
Yeah, so I think it does, indirectly. We don't hold a lot of Chinese debt. Our banks don't hold a lot of Chinese real estate debt, and we don't have a lot of investments over there, some, but not a lot. But China has been such a real estate dependent economy that if we had a meltdown there, because a lot of empty investment properties, you've heard about the ghost cities, they build and build and build because the local communities get big tax revenues by selling the land, and investors really haven't got a good alternative other than real estate as an investment. If we had prices drop 20 or 30%, it got out of control. Financial institutions had a lot of bad debt there. It could force the government to withdraw some of its trillion-dollar investment here in our treasuries, which could push up our interest rates because China holds a lot of our debt. But that is one thing that could happen. Offsetting that might be a weak China economy might affect stock markets around the world. People think there's a contagion effect, and that could be a negative. On the positive side, if China's insatiable demand for commodities were to be reduced, we might well see some of the price pressure off on some of the commodities like steel and coal and oil that we have. Now, the opposite's happening now. So I think China, anytime a large economy experiences a hiccup, could be a problem. Unlike our own housing problem that we had in 2007, 8, 9, where the rest of the world bought our debt, so we were the contagion factor, I don't think China will be that big a contagion factor. But it's disturbing, especially if they try to take military action against Taiwan or something else, well, to distract people. So you don't want this to happen. We'd like a soft landing there. That would be the best outcome for us all.
All right. There's two questions around supply chain. So if you give me a moment, what I'd like to do is read the first one and then intersect the second one too, because I think your answer will probably encompass all of them. So the first is regarding the supply chain bottleneck. If the supply chain bottleneck disrupts holiday purchasing activity, what is the risk of recession? And then, let me find this. And then the other question that came in is, what is your view of the global supply chain congestion on the U.S. economy? Is it going to overheat? Is there going to be a correction? So I think those two questions are kind of in conjunction with each other. So do you mind expanding upon that?
Sure. So the supply chain issue we have is we've abandoned a lot of our manufacturing, as you know, and let Asia be our source of manufacturing goods, China being the prime one, but also Vietnam and other places. And so we've had a simultaneous recovery here and in Europe, and we're all demanding goods rather than services because things were shut down. So we had this huge surge in demand for goods at the same time that China's economy was somewhat shut down because of COVID restrictions. and then we don't have enough containers to get everything over here. We've had port shutdowns somewhat in China and other places, and so we've had this congestion. It means that if you're ordering something, let's say for your projects, you might have a 3-month wait. I think the Christmas season is going to see shortages of some of the popular things that people want. We've got, I think, over 70 ships waiting outside the LA harbor, a lot outside of Savannah, other places. So I don't think it causes recession. It causes inflation, some of which is transitory as people bid up the prices of things they need. But it doesn't cause a recession, but it does make the growth not as strong as it would be. I do think the long-run consequences of this is we're going to localize more production. We're going to move production back onshore for things that, especially things that we need. Computer chips is one element of it, but medical equipment, vaccines, we're going to start localizing more production. I think this administration, I've heard the Department of Commerce Secretary, Gina de Raimundo, who is fantastic. I actually know her personally. She used to be the treasurer of Rhode Island and then governor of Rhode Island. Just an incredibly smart person. But it takes time to do that. So that's why the inflation pulse is going to last longer. It doesn't create recession, but it does create inflation. It does create slower growth possibly than we could have otherwise. But as we onshore things, produce more stuff here, factories here, more jobs here, I think long run, it's actually a good thing to have just in case inventories and more localized production and less reliance on cheap overseas labor, which is getting less cheap, by the way, as well.
All right, thank you. This next question kind of ties in with the same theme, and that is, do you anticipate a significant increase in demand for warehouse space, which I think ties in with your theme about increased manufacturing?
Yeah, so warehouse space has the tightest vacancy rate of any property sector in real estate. In many markets, vacancy rates are below 3%, 2%, 1%. In LA markets, it's below 2%. In northern New Jersey, it's below 2%. Nationally, it's 4.5%. And there are 80% of the markets are so tight, and so we're getting a lot of building, double the amount of normal building for warehouses. And I think as we localize more production, as we have just-in-case inventories, I think the warehouse market has a lot of legs. We never think of warehouses as the hot sector of real estate, but it is the hottest sector. A lot of capital flows and returns based on NCREIF index. Warehouse total returns, including cash flow and change in value, are up 20% in 1 year. There's no other real estate sector except single-family housing that shows that. Now you worry that as a lot of capital flows in there, will they build too much? In many places, it's hard to build warehouses, but in other places, it's not so hard. So it is a hot sector, and it's reflected in the marketplace today.
So, taking this one step further into a different sector of real estate, do you think that the supply of housing will keep up with the current demand?
Well, many of you might have seen a study that was quoted in the Wall Street Journal. We've not put on enough housing over the last decade in the U.S., partly because its land use policies in many of our dense urban areas are very difficult to get stuff approved. And so we've lagged behind. So supply has not kept up pace with demand, especially at the affordable part of housing markets. And so that's why we've seen the price increases and rent growth as we have. I think supply is going to try to catch up with demand, but now we have the shortages, labor shortages, others, so it's going to try to catch up. But over the next decade, we're going to see housing demand still be very strong as the millennials turn into home buyers, the next generation becomes renters, and then as more people retire, people are going to want retirement housing of various types, second homes, or assisted living facilities. So the demand for residential real estate is going to be strong. It might not be so strong for the big houses in the Northeast and Midwest as people move out of those locations. So there is going to be some dislocation. But I think the demographics are likely to continue to make that sector very strong.
Awesome. Thank you. On a slightly different subject, what is your view on the return of business and group travel and when, given the increase in remote work and meetings?
So that is a question everyone has, and I think that a more hybrid environment will last for some time, but I don't think people are going to give up their offices. I think they want to be in their offices, but they need to have the other things around them, the amenities and perks of being in an office. And so it's going to take a little while for that to adjust. The travel, the business convention and travels have been such a big part of many of our real estate related and other industries. I think that's going to return. I did not go to the ULI convention in Chicago. I heard there were 3,000 people there in person. I did it virtually because 3,000 people seems to be too much at this stage, even with a booster. But I think once the virus dies down, I think it's a pent-up demand for travel and meetings. It's part of the whole business milieu. It's not just getting business, but if you don't appear before your clients, I think if you don't see your boss, I think it's going to be hard to do things remotely for a long period of time. We've done it for 20 months, worked okay, and I'm sure there's some structural shift, but there's a pent-up demand for international travel by everyone. So I think we're going to see a revival, but it might take more of the virus control yet to make that happen. So maybe it might be another 18 months to 2 years before we get back to normal there. Unfortunately, longer than I would like. Being older, I want to do it now. I don't want to wait.
I can appreciate that. Let's talk about labor for a moment. There's a couple questions